Hello guys, welcome to our new YouTube channel, Elite Economy. Today, we'll discuss a key topic that impacts every Indian citizen. Why the RBI has kept the repo rate steady at 6.5%. In this video, we'll break down what the repo rate is, what happens when it is high or low, why it hasn't been changed, and the pressures RBI is facing right now. Stick around till the end of this video. Let's begin by understanding what exactly the repo rate is. What is repo rate? The repo rate is the interest rate at which the RBI lends money to commercial banks for short-term needs. It's like the RBI is a wholesale lender to banks. For example, if the repo rate is 6.5%, a bank is borrowing about 100 crore rupees from the RBI, will pay around 6.5 crore rupees annually as interest to RBI. This rate influences loan rates for customers. What happens when the repo rate is high or low? When the repo rate is high, borrowing becomes costlier, reducing spending and slowing down inflation. But it also discourages businesses and individuals from taking loans. When the repo rate is low, loans become cheaper, boosting spending as well as the investment. However, excessive borrowing can fuel inflation if demand outspaces supply. Here comes the question why the repo rate is not changed. Despite the slowdown in economic growth, the RBI chose to hold the repo rate at 6.5% to control inflation. Recently, inflation breached the RBI's comfort zone of 6%, driven by rising food and fuel prices. For example, reducing the repo rate might make loans cheaper, but it could lead to higher spending on essential goods like groceries as well as housing, which impacts causing prices to rise further. The RBI's decision aims to keep inflation in check while avoiding long-term economic instabilities. Let me introduce what are all the pressures that RBI and the government of India is exhibiting to reduce interest rates. While inflation control is critical, the RBI and the government are under immense pressure from various sectors to lower the repo rate. Here is why. The first pressure would be the economic growth slowdown. The GDP growth forecast for financial year 2025 has been reduced to 6.6%. Industries like manufacturing, startups, and real estate are struggling due to high borrowing costs. Next comes the second pressure, which is the liquidity crunch. Tight liquidity in the banking system means businesses face difficulties accessing funds. Lowering the repo rate could improve the situation. The next pressure would be the public demand for lower EMIs. High interest rates are making home, car, and educational loans expensive. Reducing these rates will increase the affordability for common people. The fourth pressure would be the global competition. Other countries are lowering rates to stimulate growth of the economy. India risks losing foreign investments if rates remain high. By getting this information and necessary insights, I would like to conclude that the RBI's decision to keep the repo rate at 6.5% reflects its focus on balancing inflation and growth as well. While this decision helps control prices, it slows down borrowing and spending, affecting businesses and individuals as well. As inflation stabilizes, the RBI might adopt a more growth friendly policy. This decision impacts everyone, from the cost of your groceries to your EMIs. What is your take? Should the RBI focus more on inflation control or boosting economic growth? Let us know your thoughts in the comments below. If you really find this video informative, don't forget to like, share, and subscribe to our new channel, Elite Economy. See you in the next video. Bye bye.